Are there really ever coincidences anymore at these levels? The United States certainly is a very, very powerful, great country, but many of the nations whom are rallying against us using commodities as a sidestep to the dollar and the treasury market hegemony, they have a say in all this too. And to your point, the Shanghai Metals Exchange, as you and I have talked about on many occasions, is not only trying to gain credibility and have other countries store their metal with them. Remember, they're in the process of building multi-jurisdictional vaults all around the world, starting first in Hong Kong, now in Saudi Arabia, and then ultimately through the Belt Road. Now, China, the second largest producer of silver in the world, David Morgan will tell you when he went to China, they tried to tell him they were number one. So number one or number two, number one gold, yet they're flying all around the country, buying all around the world, Latin America, Peru, and Mexico primarily, buying doré, which are crudely refined bars, and concentrate, the byproduct of the mining process, directly from these players, disintermediating the market, right from the miners, disintermediating the market, and sending it all the way back to China on their expense, paying double what the West will to refine it themselves. These metals are becoming very critical to them. So yeah, why wouldn't they want this to happen, to allow the price to go much higher? And how do they do that? The same way I've been saying this since the first interview you and I did together years ago. They're draining the exchanges slowly and methodically. They're standing for delivery in London. The London Metals Exchange has the lowest amount of silver, the float, they've ever had in the 140-year history of the exchange, at least since they started keeping records. And so they have been using the idiocy of the Western suppression system to beat us at our own game. The part that most analysts and most naysayers have a hard time justifying when we say this is that they haven't done it like that. Everyone in this country expects instant gratification, and if it's not fast enough, if it's not immediate, it ain't fast enough. That's their genius. Slowly enough to not rattle the bushes. But they've done a yeoman's job at that. Look at the countries involved. Saudi Arabia, Russia, China, yeah, they're all accumulating silver in their own way as fast as they can, but also gold, not too fast. And many of the other nations are too. So yes, this would indeed, and the mistake that we make in this country is thinking that we are omnipotent and we have the ability to control everything. And you know what? As I've said with you before, these countries are now sophisticated, coordinated, motivated, and they have a plan that is methodical, a plan that drives the analysts in the West nuts because it's not in your face, bang. No, but take a step back. It's just like the title of my show, little by little by little by little by little, and then bang, all at once. And we haven't seen the all at once moment, but is this the beginning of it? Maybe, could be, don't know. But absolutely, to your point, this would benefit not just China, but all of the BRICS nations. To say that they have a hand in all of this and to poo-poo it and say no way is as naive as a mud wall. It's absolutely, I think, very plausible that the Chinese have not only interest in seeing this, but are understanding that their actions and slowly exacerbating it ultimately is to their best interest.
Is there a way that China could physically help engineer the squeeze?
Yeah, by standing for delivery all around the world. And that's what they've been doing. I believe that they have been involved in shorting the paper price as well, because if you can't beat them, join them, and then going all around the globe in places like London, in places like Shanghai, all around the globe, including the miners directly, disintermediating the marketplace and pulling silver inexpensively at a subsidized price because of the futures leverage, because of the suppression, and buying as much as they can, anything that's not nailed down all around the globe from centers that do not trigger price discovery. It's the COMEX that triggers price discovery. And so they're using the suppression of the Western paper market and probably adding on to it in an effort to do exactly what we're talking about, slowly, instead of suppressing the market for other gains, political or militarily or whatever it may be, dollar supremacy, bond market supremacy, pick your poison. They're doing it because they realize we are entering a period of time where commodities will define the strength and legitimacy of a nation. And those commodities are not just going to be gold and silver and platinum. Platinum is another example where the head of the TOCOM, Bruce Ikamoto, or I'm butchering his last name, but Bruce, the head of the Japanese TOCOM, says they're trading over 3 million ounces of platinum a day in London, but in, as he says, local, meaning location, London and Switzerland, 0 ounces available. What could possibly go wrong if you're trading 3 million ounces of deliverable spot contracts a day against nothing? And the same thing is true in London. What could possibly go wrong when you have 140 million ounces with 2 billion ounces in contracts out there that could stand for delivery, not to mention the 600 million you're trading per day? What could go wrong? The Chinese slowly played this game and buying it all around the world, including London, and they're achieving it by using our stupidity, our hubris, our suppression against us. Now, there will be some metal that will go back to London. There are a lot of players in that market, and some don't see the big picture. Some want to capitalize on the arbitrage. To the extent of what you're reading in Bloomberg, there is some truth to it. But on a big level, I don't think you'll see more than 5 or 10% of the metal that's shot back here go over there. And it will just be a few players trying to arbitrage the big money who's been bringing in billions and billions a week in this stuff. I think they have bigger ideas and bigger plans for where silver's ultimately going to go. Let me say it one more time. The most powerful nation on the earth, the United States government, who really doesn't have much in the way of silver, who's importing billions of dollars a month, billions and billions and billions a week and month into COMEX and other areas that we probably don't even know about, buying directly from local and artisanal mines, has classified silver as a critical mineral. What does that tell you about what the U.S. government sees in place or has in mind for silver? These are the crumbs that a lot of people will just blow right past and ignore. To me, if you are a country who classifies an asset as a critical mineral, you're not going to let it all ship away. And so the majority of the metal that's come in under the guise and BS to that of tariffs and arbitrage, I believe has twofold implications. One, I think it was brought back to cover the short positions of many of the U.S. banks who are short in New York and long in London. They brought back their London metal to cover their shorts. And if I had to guess, had a gun to my head, I would say they've worked out a deal to deliver that to the U.S. Treasury under the guise of the Exchange Stabilization Fund to help build a stockpile of critical minerals and elements.
One of the things we really should talk about, because as much as metals have moved, one of the things that has happened is there has become an enormous spread between the bid side of silver and the trading price side you see quoted. And I want to explain that to you because if somebody calls us in today or tomorrow and says, Andy, I want to sell 2,500 ounce bars, and we give them a number, you need to understand why it may feel strange compared to what you're watching on your screen. Here's how it works. My dear friend Michelle McCrory just sent me something because I think it's important to understand. She sent me a note that says, Australia's Perth Mint has halted all silver product sales due to overwhelming demand and supply chain issues, while a U.S. dealer has frozen transactions as of October 13th, 2025. She quoted a publication saying the shortage stems from industrial demand in solar panels, electronics, and EVs outpacing mine production by hundreds of millions of ounces annually, driving spot prices above $50 per ounce and record premiums on physical bars. Experts highlight plummeting vault inventories and refining capacity strains as key factors fueling further price increases. Now, whether every single detail of that report is 100% verified, I can't guarantee. But what I can guarantee is that the trend is unmistakable and it's visible from many corners. From dealer emails to vault reports, the principle is clear. Physical supply is under serious stress. So here's the bottom line. If I buy back metal from people, I have to hedge it. If we have 1 million ounces in our warehouse and the price goes down by $1, we've lost 1 million. So I have to hedge to protect that. But what if I go and buy physical at, say, $52, and I try to hedge using futures contracts, and the futures contract is only trading at $49? The hedging cost is broken. I'm exposed. I either have to accept that exposure or reduce my volume, or both. That creates a situation where even if the headline spot price is, say, $52, the price at which I can liquidate or hedge might effectively be materially lower. That pushes down the bid side for someone selling large bars. It increases the spread between the price you see on screen and the price you net as a seller. When I talk to my suppliers, they're saying, we're halting trading until we get a handle on premiums, availability, and the spread. Now, a few people have reported refiners pushing retailers to buy back junk silver or sterling silver at 50% below spot. I will tell you, at least in our business, That's not true in our market. We're offering somewhere around $3 to $4 back from spot in some cases. That's still a big discount and unusual, but nowhere near 50%. So don't believe the worst-case rumor without verification. But also don't dismiss the fact that spreads are weird, premiums are high, availability is tight, and the system is strained. If someone asked me, should I move 1,000-ounce bars into smaller denominations right now because of this huge demand and premium? I'd say yes. Think about liquidity. Smaller bars, coins, rounds, they tend to trade more easily, especially when supply is stressed. The premium for small denominators will go up, but the ability to move them is better. Speaking of premiums, we are seeing them blow out. One dealer quoted a 10-ounce bar at $569.98 when spot was substantially lower, a clear sign of skyrocketing premium. We are still below that in our buy-side stuff, but mark my words, inventory is depleting. The question you'll start hearing every day is, do you have any silver left? And the answer will increasingly be, yes, but don't look. We're watching closely. Why is all this happening? Because the system is telling you something. Physical is being demanded in increasing volume, while paper promises continue to dominate in a massive way. The discrepancy between what you see quoted and what you can actually transact or hedge is growing. To give an example, in the London market, the London Bullion Market Association, LBMA, there may be a free float of only about 140 million ounces. Yet paper trading volumes run to hundreds of millions of ounces. The physical/backing ratio is getting worse. The lease rates for borrowing physical silver, so you can deliver it short, have spiked into double digits, even into the 30 to 40% or higher zone in London. That tells us that no one wants to lend physical silver because the cost is now huge. That's a clear stress indicator.
It's really very unusual. Really what is so unusual, Michelle, above many other things, is the resiliency that we see with the spot price. They will, like, for example, on Friday, if I'm not mistaken, it was Friday, they knocked it down hard, a couple of dollars, under 50 into the $49 range. And just like that, by Tuesday or Monday night, last night, it was at $53.30 spot price. Now, that would have been in Asia trading. And now they've knocked it down again today, trying to mitigate its rise. And today, right now, we are, where are we? We're right around 51.60 or so, climbing back up. The strength that it is exhibiting in the face of continued attacks on it, a huge backwardation, something I've never seen before, as much as a $3 spread between the spot market, the OTC market, and the December futures contract. This shows a massive stress in the system, unprecedented strain. To your point, it is unprecedented, and it's not just volatility, Michelle. It's kind of, to me, it's the market exposing the shortage of physical silver and the fragility of the paper promises. I think this is something that is far more than just a one-off. It's something I've never seen before. First of all, what it tells me is more than anything is that buyers aren't just rolling contracts over the way they used to. They're standing for delivery. They're demanding the real metal. And to me, the takeaway is that the rush for physical gold and silver is real, and it's intensifying. And markets just aren't trading paper contracts any longer. They want metal in hand. Now, this is multiplied by delivery strain. You and I have talked at length. Since November, we've seen a continual influx of metal coming into the COMEX market. And you can blame it on tariffs or blame it on arbitrage or blame it on whatever you want. I don't believe any of that. I think this is much deeper. There are people that want us to believe it's not as deep. Even the article that says that there are ships that are being loaded up to send silver over to London. I don't believe that at all, as a matter of fact. I think that's spin doctoring, kind of to buy some time for the LBMA. If silver was so plentiful, they wouldn't need a PR scheme to tell us about the silver that's heading over there. I don't believe it at all. But when you talk about exacerbating what's happening, we've already seen almost 17 million ounces of silver delivered into COMEX in the month of October. And when you see a London spot silver price at a $3 premium to the New York futures, a spread that hasn't been seen maybe ever, at least since the Hunt brothers in 1980, and borrowing cost in London that has spiked to 100% annualized, worse than the 1980 panic. What this tells us is that the demand for physical silver at the highest level. We've talked about the central banks buying it. We've talked about China buying it and flying around the world and buying doré and concentrate. We've talked about Russia and their really massive acquisition of silver over the last 5-6 years. We've talked a lot about Saudi Arabia and their fund who just bought a few $100 million worth of SLV. And that sucks in and of itself that it was SLV. But remember, at the level they paid or bought, they can stand for delivery.
You know, the big question I keep getting from people lately is this. Andy, is all of this just a coincidence? Is it just random that all of these things are breaking at the same time? The COMEX backwardation, the Perth Mint halting sales, the lease rates spiking, the dollar wobbling, the BRICS talking about gold-backed trade settlement? Is it all just coincidence? And my answer, every single time, is no. There are no coincidences at this level of the global chessboard. These are connected events. What we're watching is the slow-motion unraveling of a monetary order that's been in place for over 80 years. And silver, of all things, may be the detonator that lights the fuse. Look, the United States is still a powerful nation. We have the world's deepest capital markets, the reserve currency, and an unparalleled military footprint. But the rest of the world is no longer content to sit on the sidelines while we use that position to export inflation, weaponize the dollar, and control the pricing of commodities that other nations actually produce and consume. They've had enough, and they're pushing back, strategically, quietly, and in a way that most people in the West can't even recognize yet. You want proof? Let's talk about China and what they've been building for years under our noses. The Shanghai Metals Exchange is not just another trading venue. It's becoming the backbone of an alternative monetary infrastructure. China has been working to gain credibility by offering other countries a place to store their metals, settling trades in yuan, and expanding its footprint globally. They're building multi-jurisdictional vaults, one in Hong Kong, another in Saudi Arabia, and more along the Belt and Road. This isn't random. This is monetary strategy through logistics. Now remember, China is the second largest silver producer in the world, or possibly the first, depending on which analyst you ask. David Morgan once told me that when he visited China, they were adamant that they're number one. Either way, they're not just mining it, they're hoarding it. They're flying around Latin America, especially in Peru and Mexico, buying doré, those crude, semi-refined bars that come straight from the mines before being processed. They're disintermediating the traditional Western refining and trading system. They're cutting out the middlemen, buying directly from the source, paying higher premiums than Western refiners would ever offer, and shipping the metal back to China for final refining. That's the key. They're using our own suppressed paper pricing system to accumulate physical metal at a discount. You see, for 50 years, the West has used futures contracts, swaps, and derivatives to suppress precious metals. The paper market set the price, not the physical markets. But China looked at that setup and realized something brilliant. If the West is dumb enough to keep selling paper silver at a fraction of the real value, why fight them? Let's use that system to buy up all the real metal quietly. And that's exactly what they've been doing, slowly, methodically, and strategically. Most Americans don't understand this because we're addicted to speed. We want everything now, instant gratification. But China plays the long game. They're patient. They've been draining the exchanges little by little. They stand for delivery on contracts. They build stockpiles while the West debates whether gold and silver even matter anymore. They understand that in the next phase of the global economy, commodities will define sovereignty. And if commodities define power, then precious metals, the foundation of sound money, are the crown jewels. Take the London Metals Exchange, LME. It's been around for nearly 150 years. Right now, it has the lowest amount of silver float, available deliverable metal, in its entire recorded history. Think about that. A century and a half of operation, and the cupboards are bare. Meanwhile, countries like Saudi Arabia and China are signing new bilateral trade deals outside of the dollar, often linked to commodities and, increasingly, to gold. This isn't theory, it's happening. Now you might ask, would China or other BRICS nations actually want silver prices to go higher? Absolutely. Why wouldn't they? They're accumulating it. They produce it. They use it. And they're ready to reprice it when the time is right. It benefits every major commodity-producing nation. Russia, South Africa, Brazil, India, China, Saudi Arabia. To have the world move away from fiat debt and toward asset-backed trade, the only nation it hurts is the one that's been living off the privilege of printing the global reserve currency, us. And this is where hubris comes in. For decades, America has assumed we control everything. We set the rules, we police the markets, we decide what's fair value. But those days are ending. The countries on the other side of the table are no longer unsophisticated. They're coordinated, motivated, and most importantly, patient. They don't need to crash the system overnight. They just need to keep buying, draining, accumulating, little by little, until one day the West wakes up and realizes the vaults are empty. That's when the bang all at once moment happens. That's the title of my show for a reason. Little by little, then all at once. And make no mistake, we haven't seen the all at once moment yet, but we're getting close. Every data point is moving in that direction. Record backwardation, disappearing inventories, refinery bottlenecks, and now political realignments in the Middle East and Asia that favor commodity-backed trade. Could this be the beginning of that all-at-once moment? Maybe. Maybe not this month or even this quarter. But it's coming. And when it hits, it'll happen faster than anyone expects. When silver breaks, it won't just be a price event, it'll be a confidence event. Because silver's role is monetary. It always has been. If silver goes no offer, if physical delivery fails, that's the monetary system's equivalent of a cardiac arrest. Now let's talk about how China might be engineering this squeeze, whether intentionally or opportunistically. It's not by dumping the dollar or hacking exchanges, it's by standing for delivery. They're taking delivery on contracts all around the world, in London, in Shanghai, even in New York through proxies. At the same time, they're shorting paper markets when necessary to suppress price, so they can buy more physical on the cheap. They're playing both sides of the table. They've joined the game that we created and are now using our own rules against us. Think about it. Every time Western analysts cheer that gold and silver are under control because futures prices dropped, what's actually happening behind the scenes is that tonnage is being pulled out of the system. Bars are leaving the West for the East. Those bars aren't coming back. They're not leased. They're owned. They're stored in Chinese and Saudi vaults. Jurisdictions where the U.S. has no access. That's not temporary arbitrage. That's strategic depletion. And it's not just silver. Platinum, palladium, nickel, and rare earths, same story. Bruce Ikemisu, head of the Tokyo Commodity Exchange, said recently that London is trading 3 million ounces of platinum a day, yet there are 0 ounces available for immediate delivery in London or Switzerland. 0. What could possibly go wrong with that? A massive market that trades millions of ounces per day, backed by 0 real metal? That's the same story with silver. You've got roughly 140 million ounces of real metal floating around against billions of ounces of paper claims and 600 million ounces trading daily in derivatives. It's an illusion of liquidity. At some point, the illusion ends. You can't trade what doesn't exist. The Chinese understand that. The Russians understand that. The Saudis, the Iranians, the South Africans. They all understand that. They've been quietly preparing for the endgame, a commodity-backed trade system that dethrones the US dollar as the global reserve. They're not going to announce it on CNBC. They're just going to do it by standing for delivery, by accumulating reserves, by slowly bleeding the West of real assets.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.